Hi, everyone. Welcome to a special edition of our Savvy Tax Planning monthly podcast. It's actually a video podcast for subscribers of Savvy Tax Planning membership at Horse's Mouth. But we've got Debbie Taylor today, and we're live streaming right now to you out on Facebook, YouTube, and LinkedIn. And the reason we're doing it is you probably know in the news, there's been a lot of talk in Washington about some tax changes. There's a bill that's being hammered out in the House. Who knows what's really going to happen? But Debbie Taylor has been climbing all over it for the last 48 hours. Debbie, come on, say hello. And, you know, we're going to use this live stream to dive into it. And Doug Pierce, I guess we'll be able to take questions as well. Is that correct?
Yeah, we can take them. I can read them to you guys.
Okay, super. All right, so Debbie, come on, and what's happening? Give us a thumbnail of what has transpired, and then let's dive into, you know, you have some slides you're going to share with us here, and we're going to chat along the way. So let's get to it.
Good, that's great. So welcome everybody. So Wednesday afternoon, the House Ways and Means Committee approved the tax bill. And so that was literally just 2 days ago. It is designed to raise $2.9 trillion over 10 years and is primarily focused on the businesses and the wealthy. So over the last 48 hours, people like myself, Jeff Levine, and anyone who's super passionate about this stuff, we've been digging in, trying to learn everything we can. And having said that, Sean's point is a good one, right? There's a caveat here, is that yes, this was approved by the House Ways and Means Committee. The Senate Finance Committee has to come up with their own version of it. Then it would have to go to conference committee and get approved, right? And so there's many steps between here and the end. But having said that, we are seeing consistent themes throughout that we should be paying attention to. We are seeing some big surprises. And remember, the Democrats have been intentionally mum about the tax package since Biden was elected, because they did not want to give the opposition time to, join forces and to create all kinds of challenges and drama around it. So this has been sort of behind the scenes, hush, hush, little quiet chatter, filling in the blanks a little bit. So really, this is the first look at the direction that the Democrats want to go. Now, having said that, remember, these are very tight margins. Nancy Pelosi can only lose 3 Democrats. Okay, if she loses more than 3 Democrats, it's not getting through the House. And already one Democrat on the House Ways and Means Committee did not vote in favor of it. The vote was pretty much party lines. But one Democrat from Florida did not vote in favor of it. So she can only lose 3 Democrats in the House. And we know, of course, that the Senate has got to be 50-50. And we know that Senator Manchin has been, raising objections all along on certain aspects of it. So it's very tenuous at best. But having said that, there are themes we need to be paying attention to. And that's what we're here today, is to talk about some of those themes and talk about what we should be speaking with clients about, how we should be preparing, all of that. So I'm just going to stop there for a second. Sean, any initial questions before?
No, well, let's just give us the main headlines, I guess, right? Should we go through the main headlines and then drill down on a few of them?
Yep, of course. Okay, so on this slide then, so here's the thing. The bill is mostly focused on the quote wealthy. And for our purposes today, we're going to define wealthy as single taxpayers with over 400,000 and married filing joint with over 450. Okay, so right away.
Earning, you said with, you mean earning, right?
Earning. Yes, I'm sorry. Okay, so right away, the single should go off marriage penalty because it's $400,000 single. Right, that's what they're considering to be the wealthy, who they're really targeting, right? And 450 for married filing joint. So what I said to my husband this morning is that I'm going to have to divorce him, because if we were both single taxpayers, then we'd have up until $800,000 of income before some of these draconian changes kick in. And so I'm sure we're going to see a lot of interesting analysis based on, honestly, 2 single people, whether they should be getting married or not, because there is a huge marriage penalty here, not even close. So anyway,
I just want to point out, because I know something about your personal life. You've got a son off. The last one is off to college. You've got the empty nest, and the first thing you're discussing the next day over coffee is getting divorced.
Well, with this tax package, I mean, how could you not address that? You got to be practical about things, Sean. And so anyway, so for our purposes today, it's 400,000 single, 450 married. Now, remember, this was part of Biden's campaign pledge, right? Nobody who made less than $400,000 a year would be affected, right? That was his campaign pledge. And on some level, he's eating his words, because you're going to see all these like inconsistencies based on the House proposal that tie back to this $400,000 number, even where it sort of doesn't make sense and you're scratching your head. So it's sort of, he's sort of eating his words on that, but be that as it may. And so anyway, they basically are saying that this 400,000 number really affects only the top 2% of taxpayers. And we know that there's been this sort of push on the 1%, the one percenters, right? The problem is that for your practice and my practice, this doesn't affect only 1% of my clients, right? This affects maybe 50% or 25 or 75%. So unfortunately, or fortunately, our clients are not just 1%, right? Within our client base, it's probably 50% or 75%. And so I'm calling this the Full Employment Advisor Act. Because for those advisors out there who are listening and educating themselves and signing up for the Horse's Mouth programs, you are going to be in a great position to guide your clients and make a difference in their lives. And so it's an opportunity for all of us. And of course, with all of this legislation, do not forget about the Secure Act, right? I mean, I cannot not remind you the Secure Act continues to hang out there. And so with that, then we can hop in, but I'll stop for a second. Sean, any questions or points that you want to make about any of this?
No, except for that when you reference the Secure Act, and you're referring to the large traditional IRAs, can you just flesh that out a tiny bit so we know specifically what you're referring to?
Sure. So this is, like an obsession of mine, right? Is clients with large traditional IRAs or traditional retirement accounts. So also their 401ks, right? So any of those traditional monies, they are subject to the Secure Act. And within our firm, we basically target anyone that's got $1 million or more in those traditional retirement accounts, that we've got to have those conversations and start doing that analysis to see how we can drive down those balances so that their heirs are not subject to the Secure Act, which is basically that 10-year withdrawal of any beneficiary IRAs, right? Any IRAs that go to your children, they would be stuck over pulling out that money over a 10-year period with very limited exceptions. Having said that, remember that I don't want anyone using $1 million as a hard line, because let's say you have a client who's in their like 40s or early 50s and they have, $800,000 in their 401k. Don't be like, well, oopsie, I like have a cutoff at $1 million. We, ran a search of all of our clients, because that client in their 50s with an $850,000 401k, if they're continuing to contribute and just by time, they will then get to an amount that their heirs will be exposed through the Secure Act. So you've got to be thoughtful in how you approach it. And we come at it from a number of different aspects, with these clients. So yes.
Okay.
Okay.
So sorry, we had a question from Maureen who wants to know, is this taxable income or adjusted gross income?
Taxable income.
Okay.
So, all right. So the Ways and Means Committee approves $2.3 trillion in the tax hikes. So here's just some of the data. The vote was 24-19, basically along party lines, as I had suggested, but one Democrat defected. Okay. So what are we doing? Increases the top marginal tax rate to 39.6%. So remember, right now it's 37%, would go to 39.6%. Remember, that's what it was before the Tax Cut and Jobs Act of 2017. So basically bringing back that old highest tax bracket of 39.6%. But we're going to be hitting that 39.6% tax bracket a lot sooner. So now you would get to that 37% tax bracket at like $622,000 of income. Under this proposal from the House, you get to the 39.6% tax bracket at 400 or 450, right? That's the wealthy. And I think I just misspoke. Just to be clear, you'd be at 37% with $620,000 of income now. So your tax bracket, your highest tax bracket is going up by 2.6%, but you're reaching there $200,000 earlier, right? You're getting there at 400 or 450 and not at 620 or whatever. Okay. So that's the highest tax bracket. Capital gains rate increases to 25%. Currently, it's 20% is the highest, going from 20 to 25. Right now, this House bill has it retroactive, okay? Retroactive to on or before September 14th. What that means is that you cannot go out and do trades for your client and think that they are going to be able to take advantage of the lower capital gains rate between now and the end of the year, let's say. They're making this retroactive. Now, it's very interesting because when Biden spoke to the House and the Senate earlier in the year, the Green Book was released. And his tax proposals that he sort of alluded to in the last couple pages, those were also then effective on the date he gave that speech. So you are seeing this consistent theme that this capital gains increase is retroactive or effective immediately. And there's two reasons that they're giving for that. Is first of all, if they make the capital gains increase effective as of January 1st, 2022, which most of these tax law changes are effective as of January 1st, 2022. Some dates are different, but most of them are that date. And we'll point out the differences. Then the idea is we'd all run and do all the selling to get the more attractive lower capital gains rate and essentially defeat the purpose, at least during this first year or two. And so they don't want us doing that. And then a secondary reason that has been sort of indirectly offered or suggested is that it would drive down the markets if everybody runs and starts doing all the selling in the last 4 months of the year. So an interesting theme to watch. What it would do is essentially make us powerless to try to do this, do these trades before the end of the year, or accelerate gains in, I was going to sell my business. Maybe I was going to do it next year. Let me quickly do it this year. They're saying that would be too late. There is one exception that I'm seeing where if there is some type of contract or agreement in place before September 14th, and it's not modified, then you could still take advantage of that lower rate. So there is some option there for that, but of course that's going to be very limited and heavily scrutinized. So that's the capital gains rate. So in addition, there is a 3% surcharge on incomes over $5 million. Okay, 3% surcharge on incomes over $5 million. No one's so worried about that probably, right? Okay. They are curbing backdoor Roth conversions. Okay. So we do this every year. We do it for all of our clients. Is they contribute their $7,000 non-deductible traditional IRA contribution. And then a week later, we convert it to a Roth, right? It's called a backdoor Roth conversion. It is entirely legitimate. The government has blessed it. Okay, there's some questions about it. They blessed it. Okay, a couple of years ago. They are going to stop that altogether for everybody. Okay, so those are going to go away. Roth conversions prohibited again for the wealthy, that 400 or 450, right? As of December 31st, 2031. So we've got 10 years, but then no more Roth conversions for those, quote, wealthy people. So to the extent that you say, well, what's the impact of that, right? To the extent that we're saying, hey, let's wait for those low income years, right? Those ideal years to do those Roth conversions. And then we'll do those Roth conversions once you retire, but before your RMDs kick in, right? Between 65 to 70, 65 to 72, right? Some clients might not have that luxury anymore, right? Is we might have to then deal with this over the next 10 years because we've got a ticking clock. One other thing I wanted to remind us is remember that capital gains, 25%. Remember the 3.8% Obamacare tax, Medicare tax, net investment income tax, NIT, whatever you want to call it. Remember that 3.8% is going to be on top of that 25%. So it's really going to be 28.8% for most taxpayers. All right, I'll stop there for a second, see if you have any questions, Sean.
Yeah, Debbie, I do on the Roth conversions. I want to be sure I understand what you're saying. So, I mean, I think I understand broadly, but I just want to also confirm that, there's this other approach of sort of filling your brackets to start to build up your Roth account and pulling the money from your qualified account. Are you saying this isn't impacting that sort of annual filling of the bracket kind of thing, is it?
I'm not sure I follow you. So
like you're saying, you've got a couple in, their late 50s, and you can see where their IRAs are heading, and there's going to be tax liabilities. So you have been encouraging them to make small conversions, make conversions over the years to, fill up their bracket. And
we got a problem. We got a problem here, Sean.
They're saying you cannot do that, period?
After 2031, if you are that higher income taxpayer, that last bullet point. So after 2031, you will not be able to do those partial Roth conversions, full Roth conversions, whatever you call it. You will not be able to do it if your income is over 400,000 single, 450 married. You will not be able to do that.
Right. Okay. But a lot of advisors have clients who aren't making that amount of money. And I just want to be sure you're saying that. And I know you've been beating the Roth conversion drum for all your clients, even right down to their kids and everything.
Yep.
That still is going to be able to.
As of right now, under this bill, yes, because again,
the 400,000
yes.
annual.
Right. And so this is where they've been, quote, eating their words. It's just sort of interesting to see how this is all played out. Is Biden all along on that campaign trail was $400,000. If you make under $400,000, you will not be affected. And so that's what I'm saying. You see all these like quirky things in here because they had to draw the line there. So yes, if you make under $400,000, you can do those partial Roth conversions. And so what it will mean for us is we're going to have to manipulate this income, level off this income, like, maybe we almost like bunching deductions. My thinking is maybe we start bunching income, right? So we're like, gee, Debbie, I have a client who typically makes, I don't know, $600,000 a year. I don't know, right? And we really need to do some of these Roth conversions. Maybe we accelerate income or postpone it, get under that $400,000, try to do a bunch of Roth conversions that year, and then go back and even make $800,000 that next year, So I think there's going to be a fair amount of sort of jerry rigging, trying to get within that $400,000 number, because you're going to see it's a cliff number, and there's a lot that's tied into it. And some of it doesn't even make sense. Like you're going to see as we move on. You're like, well, this could sort of make sense, but then you're going to see others that you're like, really? But that 400,000, he is like eating his words on that, in my view, for better, for worse.
So yeah. Debbie, sorry, we have a question from Maureen about the 400. She wanted to know, is the 400 earned income? What if clients earn this much from investments and draw down or other passive income? Roth conversion prohibition.
Yeah, I mean, my understanding is it's income. Like they don't really care how you're getting that. So that is my understanding right now.
Okay.
Yeah.
And then Terry asked, what is the rationale for waiting 10 years to apply an income prohibition to high income earners?
I think they need the income. I mean, the revenue. I think they need the revenue. Yeah. Again, I apologize and acknowledge, right? And I was saying this to Sean and Doug before, the ink is still wet on this. So we're still like sifting through on trying to get sort of the chatter, connecting the dots. And all this is going to come to light. It's like all these other previous tax packages that are passed. It's less than 48 hours. And so a lot of it is speculation. What does Andy Friedman think? What does Jeff Lund think? We're all sort of speculating. And so that's my thinking, is they need that revenue because they had to make this budget reconciliation bill work. And so all these little like nuances, like the 3% surcharge and incomes over 5 million, that was nowhere, right? This like came out of nowhere, and they needed to do that to get the revenue so that this bill could essentially pass. So they gave it up somewhere else and then pull it in somewhere else, right?
But Debbie, I want to ask you something before because I wouldn't want to snap it at the very end. In terms of advisors listening to what you're saying here, I'm interpreting this as this is a major FYI. You should be informed of this. But are there any specific things people should be taking action on now? Or is this all kind of like, we need to know about this, start talking to clients about it, and also know about it so you can answer questions from the knowledgeable, curious clients? Or is there specific actions people would be taking now?
Yeah, I think so. Some stuff, there's definitely some action, and we're going to talk about that. Like in the estate planning, in the estate planning area, like absolutely. But even like with this income area. So again, we're seeing this theme. And so it's like, you want to look at patterns, right? So the 400, 450 number, and we're seeing that consistently with this. So let's say you've got clients that are, slightly over that 450 number, or able to manipulate their income a little bit. Maybe we start having conversations with them about, moving some of that income into this year with the lower tax rates. So I would tell you some of the stuff, you might take action on it. If the action is not like so extreme that if some of the stuff doesn't happen, you'd have a problem with that client, if that makes sense to you. Okay. So for some clients, it's sort of like some gentle urging. If the cost isn't too much, maybe we do this. And then there are other things where you do want to take action because the writing is on the wall. And once the door closes on this, you will be kicking yourself. And one of them is the estate planning part of it, which I will get to. So yeah.
Onward.
And part of this also is the client's comfort level, right? So you could have these conversations with clients, and some clients are like, I get it. I see the pattern here, and I want to move forward on ABC. And other clients are more like, hey, let me just see how this thing works out because it's got to get through the Senate, blah, blah, blah. And so part of it is having those conversations, but then letting the client sort of lead the way, so to speak, about what they feel motivated to do. All right. So here's a nice little chart. This is actually from the House Ways and Means Committee. And this shows, again, a nice graphic about what Biden proposed, where the House Democrat proposal is, and what the current law is. And so again, I mean, we've covered all of this, but it's just a nice visual. I'm a very visual learner, so this was helpful to me. All right, trying to then summarize where we're at. So again, some of this we already covered, but increase the capital gains from 20 to 25% for those, those wealthy, right? That 4 to 450. Okay. Retroactive, like we talked about, plus the NIT. So we covered this. Okay. Top marginal tax rate going from 37 to 39.6%. This we also talked about, right? And then what this also does, by the way, is it finally aligns that top tax bracket for capital gains and for income, right? So you know how like your top capital gains 20%, and that was a certain number, and then your top 37%, and that was at like $600,000 plus, and it's like very confusing trying to reconcile all that. Well, now if you make over 400 single or 450 married filing joint, you will be in that top tax bracket, 37% for ordinary income tax rate and 25% for capital gains. So that's the top tax bracket applying 450 across the board or 400. Okay. One of the things to take a step back and note, this is not nearly as bad as we were, preparing ourselves for. If you remember, Biden wanted that top capital gains bracket to be at 39.6%, which is like horrifyingly, okay, I was like scary. That would have put into motion all kinds of unnatural acts, is what we call it. And so on some level, when you take a step back, this is manageable, right? A 25% capital gains rate, that's manageable, right? Right now it's 20, it goes to 25. We can absorb that for the most part as investors, right? I don't think we necessarily need to go through all kinds of unnatural acts, right? Accelerating sales and all kinds of drama. I mean, obviously, if there's a lot of money on the table or a client super tax sensitive, yeah, sure. I mean, you're going to do for them what you can, but there would have been unnatural acts if that rate went to 39.6%, right? That's when you're like, sell that business now. Well, gee, Debbie, I won't get as much for it. Sell it anyway, because they're basically doubling the capital gains rate on you. So whatever extra you would have gotten by waiting 6 months, you're going to give up in taxes. Oh yeah, I get that now. We're not going to, I would tell you, we're not going to have to go through some of those unnatural acts. Plus, remember, right now it would be retroactive anyway. So some of those unnatural acts, they wouldn't even matter. So that's sort of interesting just to sort of take a step back and think about it. The 3% surtax, we talked about it, on those who earn more than $5 million, whether single or married, they don't care, right? Single or married, $5 million. And again, this is brand new. 3% surtax on trusts with income or capital gains over $100,000. So if a trust has income over $100,000, then there's a 3% surtax on that. And again, it's just like out of left field on that. Remember, the trust is already in that highest tax bracket when it basically has like $12,900 of income, right? I mean, remember that. And so that would still stay. So those trusts with $12,900 of income, $950 of income, those are in that highest tax bracket. But now if there's income of $100,000, there's a 3% surtax on that. And then this one is connected with all that press we've had lately with that Peter Thiel, and he bought some of the stock very cheaply. And of course, Congress was all up in arms about that, right? And so this now is what we've got from it. Basically, one bad apple spoiled the bunch for the rest of us. Cannot contribute to tax preferred retirement accounts if the value of all of those accounts, so IRAs, defined contribution, 401ks, value of all those accounts exceeds $10 million. And get a load of this, your income's over $400,000 to $450,000. So just take a step back. If that's a little ridiculous, if you've got all those accounts worth over $10 million, and you've got an issue with people accumulating like that in their retirement accounts, you would think that they would just make that rule right there. But because Biden promised that nobody over 400 or nobody under 400,000 would get affected, now it's, you've got that $10 million account and you've got to be making over $400,000 a year for this limitation to kick in. Okay. And so again, I'm reading this, I'm literally scratching my head. I had to read it like 5 different times and like in all these different places to make sure we're all on the same page with this. What they do, if you fall into this category, is forced RMDs of 50% in the next year of the excess over $10 million. Like that's very draconian. Okay. And they have another rule for if it's over $20 million, how much you have to take out. And so this might not seem like it's really a big deal because you're like, oh, how many have $10 million? But if this sticks around, and we've got this market continuing the way it does, this could affect more people than we realize. And
Right.
so anyway, so I'll stop here on the slide and see, Sean, if you have any comments or questions on that.
No, I don't on this one. So let's keep going.
We do have a couple that came in from chat, Sean, if you want me to share them.
Great.
Yeah. So Kevin asked, question, that means that the converted amount itself would be part of the 400 to 450,000, right?
Yeah, I'm not sure about that part. I don't think so, but I'm not sure about that.
Okay. And then Maureen has a question. So if someone who makes $100,000 sells their home, has a gain of $500,000, so they automatically would be above $400,000 and have all the fun associated with being quote unquote rich.
Yeah. And that's one of, right. Yes. And that's one of the issues is if you've got big capital gain transactions, this is potentially problematic.
Yeah.
Okay.
Also, Debbie, I just want to note, I've seen some things, that's been going on for about a year now about accelerated retirements going on, that way more people are retiring. Now, it's not true that people retire, massive numbers of them, percentage wise, sell their homes, but still some significant percent do. So that is going to be an issue, it seems like. I mean, if this is passed.
Right. And so part of it is trying to clarify when they talk about income, what they're referring to. Will they be including these capital gain transactions, right? Whether it's a house or, or if they're including the Roth conversion. So part of it is really like fleshing out what's included in that definition of income. Right. But certainly like on that $5 million number that's on this previous slide, like they're saying, hey, you look at this and you go, oh, this $5 million, who would that really affect? Just some rich hedge fund guy. But, if you've got somebody selling a business or there's some big transaction, that once in a lifetime transaction, all of a sudden you are getting pushed into these brackets that are really targeted towards the like consistently rich, not the like one-time rich. Yeah, exactly. And so again, we've got to see how that fleshes out, but certainly something to watch. And the devil's going to be in the details on that. What counts, what doesn't count, right? Okay. Individual tax increases continued. So like we talked about, no more backdoor Roth conversion. So that's that $7,000 a year that you do for your clients, right? Now, no more after-tax contributions. So those clients that you have that work in biotech or work on Wall Street, and they're allowed to do those after-tax contributions on top of that traditional 401k, and it gets them to like, $60,000 a year, okay? And it goes in after tax, and then they can do those micro Roth conversions of that money. No more of that. So we have clients that work on Wall Street that are like at biotech firms, right? So these are generally your higher earning clients who are at those companies that folks do pretty well at. They are all going to have after-tax contributions available in their 401k programs that can get them up to $50,000 or $60,000 a year. Those are gone, regardless of how much income you make. Gone. Okay. And in connection with that is that mega backdoor Roth strategy that we talk about. So again, you're doing those after-tax contributions to your 401k that gets you to that $50,000 or $60,000 a year number in your 401k, right? The first part is that typically your traditional 401k or maybe your Roth, right? So that's that, $19,000 number, right? Then you have your catch up, right? That's that 6,500 or so. But then there's another like 20 to 30,000 that you can get in there. They're saying, no, that's going to be gone. And all these changes would be effective as of January 1st and applies to everybody, regardless of income. And so what we're seeing here is this theme, right? Is they want to shut down the Roth IRA idea. And so it's interesting because this has been a little bit of a ping pong ball, right? Is under the Obama administration, they wanted to do away with those Roth IRAs, if you remember, because they felt that it benefited the wealthy primarily. Then under the Trump administration, they liked the Roth IRAs because they wanted the revenue. Okay. Now you see them going back and really trying to shut down those Roth opportunities any which way. So this is new. This is unexpected and certainly something to watch. I'll stop there for a second, Sean, if you have any comments on that.
I'm good. Doug, what do we got out there? Anything?
Yeah. Actually, we do. We had a burst of questions come in here. So Maureen said, so this bill has so many unintended consequences. It's pathetic. Anything on Medicare, Irma?
I've not seen anything on Medicare or Irma. Nothing.
Okay. And then Kevin asked, so the $10 million looks like the success tax on plans from the 80s.
Yeah. Yes. So, I mean, yes and no, right? So, yeah, I mean, it's definitely a success tax, right? No way, other way to look at it. And you could say, yeah, right, is a success tax from the 80s. But, we can also look at it as a success tax for going forward. I mean, how many of you have clients right now who have anywhere from, $3 to $5 million in qualified money? And how long does it take for them to get to that $5 million or $10 million number? It can happen astoundingly quick. And so that's where even today, looking at some of this saying, well, how does this really affect us? Maybe not so much. But, if these accounts continue to grow, you're going to have more and more clients that end up in these crosshairs. So, yes, I agree.
And then Herbert asked, are gains from the sale of your primary home now taxable?
They did not address that. So you still have that $500,000 exclusion. Okay. So that is still intact as of right now.
Okay. And the retirement plan coach asked, so does this mean that someone over 70 can still contribute to an IRA, but not a Roth?
I haven't seen any changes on that. I didn't see any changes on that, except there was something about if you were over that income limit. I'm going to reserve on that one. Let me just think about that one. I didn't see any direct changes on that, though. I did not see any direct changes on that. Okay. As far as changing contribution allowances in general. But on the Roth, did we have something on? Yeah. Okay. Right. Let me get back to you on the Roth part of it. Okay. All right. Let me get back to you on the Roth part. All right. Gift and estate tax. So this goes to Sean's question. They are proposing that this gets halved, HALVED, halved. Okay. Starting in early 2022. And so then our $11.7 million would basically go down to $5 million plus, right? Like $5 million and change. Again, looking for themes. This has been a consistent theme is let's just roll back the 2017 Tax Cut and Jobs Act. Let's just roll it back to what it was before, which is basically was that $5 million adjusted for inflation, right? And it would be effective on January 1st. If this goes through, then this is one that you would absolutely want to be dealing with your clients right now. Now, I've already worked with my clients on this because this is one of those things that was on the horizon and the costs are way too high if this went through. And so I've already done the planning with clients who would be exposed. And so you need to look at your book because there's a good chance that this could go through. You need to look at your book and any of your clients who are single at $5 million of net worth, or even around there, maybe it's $4.5 million, or if they're a couple and they're $11 million, again, maybe 10 and a half, whatever, you need to be having conversations with them because a good argument could be made that they should use up that lifetime exclusion this year while it is still $11 million before it goes down to the $5 million. Okay. And remember, the IRS has already come out and said there's no clawback. And so if you go out today and you use up your $11.5 million exclusion by gifting, whatever, okay, the IRS can't come back next year and say, oh, you're still alive and you only have a $5 million exclusion. No, you use it or you lose it. And so if you've got clients that are in like in this danger zone, if they are worth over, I would tell you worth over 10 or $11 million, then you should be having this conversation with them to at least get that estate down to $10 million or so that if this lifetime exclusion goes down to $5 million per person, that they are like generally within that zone. In addition, beyond the numbers issue, they're looking to do away with our favorite estate planning strategies. And so basically, if you interview Debbie Taylor or anyone else doing this, and you say, what are your 5 or 10 favorite strategies? And I click them off for you, they are going after almost every single one of them. The only ones that they're really leaving away are the ILETs. Okay. They don't go after life insurance because that life insurance lobby is so darn powerful that they're protected. And actually, they're actually supportive of this legislation because it helps them, right? Is if you can't build Roth accounts, what's one of your options, right? Is life insurance, right? Cash value life insurance. And so they love it. Higher taxes helps the life insurance lobby, because then you've got to buy life insurance to pay estate taxes. So they love all this stuff. But anyway, they are looking to do away with some of the most popular estate planning strategies that you would use for your clients. So they're trying to monkey around with GRATs, okay, intentionally defective grantor trusts, and discounts on family limited partnerships. So we just had a client that we did some pretty aggressive estate planning for. And one of the things is we created an LLC, and we took a discount on the LLC. And we put individual stocks into that LLC, and we're able to walk away with like a 25% discount. They're doing away with that. They will keep LLCs for like a family businesses and provide a discount, but not for marketable securities. And so some of the stuff they're going to do away with. So again, if you've got that client with that large estate and you've got certain strategies that you are your go-to strategies, you've got then a number of issues here, because some of those strategies may not be available to you starting next year. Okay, they're closing a loophole on the S Corps because they weren't getting charged at 3.8% net. So to me, it's just like sort of a loophole. Elimination of Roth conversions in 2031. We talked about that. And here's a new one for your clients. Commodities, currencies, and digital assets are now subject to the wash sale rules. Okay. And this to me is like fascinating, because this one came out of nowhere too, is right now, if you have crypto, if you're trading commodities, and you have a loss, you can sell, bank the loss, and then buy it back the next day. The same thing, because they weren't subject to the wash sale rules. Now they'll be subject to the wash sale rules. You got to wait the 30 days. Again, we're going to have to look for clarification on that. How one crypto looks the same to me as another crypto. Are they going to consider them the same, or will they be different? There's going to be a lot that has to come out addressing that. But this is a big move. So I'll stop there for a second. Sean, were you going to say something?
No, just that, that whole thing with the crypto and the wash sale is interesting, because people have been definitely taking advantage of that,
yes,
as they move in and out and whatever.
Absolutely. I mean, these are like three of the most volatile types of assets. I mean, these are assets you trade, literally you trade, right, and not subject to the wash sale rules. Now, some interpret this actually as a positive sign, because they say that it's actually legitimizing crypto by sort of making it subject to the tax rules that other assets are subject to. So that's sort of was an interesting spin on that. I was reading that. I thought, oh, that's interesting. All right, corporate tax increases. Again, not spending too much time on this, but you should be aware of it to the extent that, yes, this could affect earnings, right? Is proposed increase from 21% to 26.5%. It's graduated, right? Sort of just like our tax brackets, it's graduated. And the benefit of the graduated rate phases out for corporations with more than $10 million. But the lowest rate is 18% on the first $400,000 of income. And so there's, some graduation here of this. Obviously lower, Biden wanted 28%, it's 26.5%, okay? And then that minimum tax, that GILTI tax. So really the idea for me behind the corporate taxes, because these are reasonable. We know we can make money when corporate taxes are 26.5%. But the idea here is it could affect some corporations who had overseas locations. Here's a nice little chart from Goldman. And you see that it could affect our technology, our healthcare, communication services, who were able to take advantage of some of these loopholes and put their services abroad and take advantage of some of the like the arbitrage with the tax structures. And so this could help some of those and will hurt some of those. And we have to see just sort of how that all pans out. Okay, so now sort of more high level. So they're closing after tax employee contributions and qualified plans for all. Okay, so that's again hurts the Roth buildup, right? Essentially, because all these things feed into the Roth accounts. So they're sort of trying to go upstream and nailing this in the bud, okay? Prohibits Roth conversions of after-tax IRA contributions and employer-sponsored plans. So this is that backdoor Roth conversion, and this is that mega backdoor, shutting that down for everybody, okay? You cannot make IRA or defined contribution contributions if the total value is over 10 million, and in fact, just the opposite. If the value is 10 million, you're required to withdraw 50% of the excess in the following year. And then if it's $20 million, you have to pull out from the Roth IRA first. on, again, trying to address some of that press. Okay. Also remember, this only applies if you make over $400,000 or $450,000 a year, which is totally ridiculous that there is that, additional qualification. But it could give us an opportunity to, like I said, manipulate our income maybe, so that we can have workarounds from these rules. So, I mean, it's ridiculous, it's illogical, but it's going to actually help some of us if we can control the income a little better, to be able to then do Roth conversions later on, if we can make sure we come in under that income threshold. Remember though, really you're limited once those RMDs start. So if you're that wealthier taxpayer and you want to continue doing these Roth conversions, yes, Social Security starts at 70, but if you've got these large accounts at 72 is when those RMDs come in, you can't do anything about those RMDs. So you're going to have to try to work on this before age 72. And so again, it's sort of interesting. And when I say before age 72, only if I'm assuming that you've got this large IRA, and so then your RMDs would put you over that 400 or 450 limit, or that coupled with other income, right? So anyway, I'll stop there. Sean, any thoughts on this? Or
just that there had been some discussion floating around in recent months about, maybe the RMD would be pushed up to 75, and then some people even speculating it would go away. But obviously, there's none of that at this point.
Not here, but they continue to work on Secure Act 2.0 is what they call that.
Right.
And again, it's so fascinating, Sean, because you and I have seen this over the last couple of years working together when all this legislation comes out, is like they'll look at part of it in a vacuum, but then you've got to look at how it coordinates with all the other legislation. So the fact that they increase the RMD age from 70 to 72, like that's going to actually help us when it's time for us to try to manipulate our income to get it under that 450 number so that we can do Roth conversions, right? Before those RMDs kick in. So that's actually nice. They gave us an extra 2 years to try to manipulate income around. Now, if they push it back to 75, again, that could give us a few extra years to manipulate our income. So it's sort of interesting to see when you pull all this legislation together, the opportunities and the limitations that present themselves.
Yeah.
And also think about it, again, taking a step back. So now we are limited in our ability to do after-tax accounts, to do Roth conversions after 2031, right? We're limited in that. So now our Secure Act problem grows even larger, right? Looms even larger, because now you come to me and I'm like, oh, well, I have this option. We can do this, we can do that. Well, now those doors are closing. And what's left are these large traditional IRA balances. As if that's not bad enough, then the Secure Act kicks in and you've got to take that money over 10 years.
Yep.
So it creates even more pressure to plan ahead and do something about it. And those people that decide to show up to your office at the 11th hour and they're like, oh my God, like I didn't realize. And you're like, okay, well, we can still do like Roth conversions for the next 3 years or whatever. Like it's going to be harder and harder to do this. And after 2031, you're not going to be able to do it if you've got that income over $400,000 or $450,000 a year. So, yeah.
Yeah. More tax chaos.
Yes, no question. Okay. So, all right. So we're cracking down on the high earners. So the theory behind this is IRAs are meant to be retirement accounts for modest savers, not a way for the government to subsidize tax benefits for the super rich. They're basically saying this legislation only affects the top 2%. That's who they're going after. And again, I know there's a question before, right, about the Roth conversions. So again, they are done at 2031, but only if you're making over that 400 or 450 number. Okay. But the crackdown on the after-tax contributions and the backdoor Roth IRAs, those are now, and they apply to everybody. All right, let's talk about estate planning. I know we touched on it, but these are some of the strategies. I mentioned it. And these are some of the things that are going to go away. So first we have just the pure numbers of it. Is if you got clients that are worth close to 10 million, if it's a couple, you absolutely should be talking to them now. And they have got to be aware of what's at stake here. We have clients in this situation, and we set up family limited partnerships to get the discount. We set up trusts to get the money out of the state. Maybe if nothing else, you set up a SLAT and at least lock in that lifetime exclusion. Now, there are risks with all these strategies. So, you've got to be very aware, but at least have this conversation with your clients, because the last thing you want is 2022 to come. They've made some of these changes and you didn't have a conversation with your client about what they could have done. The other thing is, don't assume those estate planning lawyers are doing this, and don't assume the tax professionals doing this. We've covered this ground a ton of times, and unfortunately, a lot of them are checked out. This is going to be on you to basically save the day for your client. Okay, so taking aim at the intentionally defective grantor trusts, and then you see here reducing the discounts. Existing trusts right now are being grandfathered in, which of course makes sense. And so again, if we run off and set up trusts or trusts that are already set up, those are going to be protected. Let's talk about, as I'm sort of wrapping up some of these slides, what the proposals did not change as of right now. Okay, so it did not eliminate step up in basis at death. Okay, the thinking was that it wouldn't pass. Those Midwestern congressmen and ladies with those family farms all worked up about the family farms. And so they left this one on the table. Okay. They can only afford to lose three congressmen. And so they didn't think they could get it passed. So right now the step up in basis remains. The proposal is silent on SALT, but those New York and New Jersey Congress people have band together and they're like, no SALT, no deal. Okay. And so this is something that they are going to address in, future drafts of this. Okay. And everybody acknowledges that. So they couldn't figure out SALT just yet, but they are going to have to address that. We'll see what happens. Nobody under 400,000 gets a tax increase supposedly. So that is sort of standstill. Carried interest survives. That's for the hedge fund guys. So that survived. They made a little tweak in that, but they still get that favorable capital gains treatment, and they're not taxed like the rest of us at the ordinary income tax bracket, which is a little outrageous that was able to survive. And then no changes to trusts already in existence. We had mentioned that. All right, 2 slides left here about sort of the practice, about how to think about it. So this is a little bit of a generic slide, but some solutions for higher taxes. Again, now more than ever, right, is maybe some of these tax efficient vehicles, these annuities, particularly if we've got that cliff with that $400,000 to $450,000, and over that 4 or 450, we've got all these very bad consequences. We might have to start thinking about, municipal bonds, exchange funds, insurance, annuities. And again, part of it, devil in the details, is how they're defining that 4 and 450. So we're going to have to understand that better. And once we understand that better, depending on our client and what we're trying to accomplish, we may have to massage their income and their investments so that they can qualify if the larger goal is a Roth conversion. And so some things, tax loss harvesting and tax management is going to become, again, that much more important, particularly again, because we got that 400,000 cliff. Asset location, same thing. And then gain acceleration, gain deferral, leveling out of income. And so all these tax strategies that we talk about, that we know exist in theory, maybe we practice some, maybe we don't practice others. At the end of the day, if we've got this cliff of 400 to 450, now this stuff becomes real critical to clients, right? You'd hate to tell somebody, hey, you can't do a Roth conversion this year because your income is $402,000. And then meanwhile, you had trades that helped to get them over that $402,000, right? You don't want to be the one delivering that news and punishing that client. So we're going to have to really, we talk about that Medicare IRMA surcharge, like that cliff tax, we make a big deal out of it. Oh, client could get charged $2,000 extra a year in premiums because they're $1 over that cliff. Now look at what's at stake if you're over that cliff, right? So we're going to have to really dig down and understand what that looks like. And here's 8 essential questions, right? So you're like, wow, there is so much here. Like, who are the folks that we need to be thinking about? And so high level, these are the folks we need to be thinking about, right? Is looking at their income, okay? And do they fall into any of those income buckets there? Do we have large unrealized gains that we're worried about that would be taxed at $25,000 if we're over that income number? Do we have that larger estate that we need to worry about? That's item 3. Do we have pre-tax retirement accounts that we wanted to convert to Roths? Well, if that was sort of part of our like long-term plan, well, your long-term plan has now become short and intermediate term plan because you've got within the next 10 years to do it if you're a high earner. Okay. Backdoor Roth conversions, converting after-tax contributions, you got this year and then you're done with that, no matter how much money you make. If you're contemplating different estate planning strategies, then you might want to be doing them this year. Even for those of us who have our own business and we're thinking about like setting up family limited partnerships as part of our succession plan, that might be work that gets accelerated into this year. That maybe we're going to do it 2 years from now or 3 years from now. If you've got those large traditional retirement accounts, now we got to worry about some $10 million bogey, which we could grow to, some of us. And do you own these digital currencies, digital assets, crypto, whatever? Now we got wash sale rules. And let's not forget the Secure Act, which continues, in the background. So those are some thoughts.
All right. Well, Doug, we have any questions out there? But before we get to the questions, I just want to remind anybody who's listening, who's not a member of the Savvy Tax Planning Program, that, this was a special edition and, this is the kind of material that people get access to in our Savvy Tax Planning Program. That's how you could get access to it as well. And so go to horsesmouth.com/tax to learn more about that program and get signed up. So that's my pitch before we wrap up with any remaining questions. Doug, what do we got?
Yeah, we have a few questions that have come in. So the retirement plan coach asked, if you can't do a backdoor Roth, can you contribute to an IRA, then partially convert?
I mean, that's a backdoor Roth. That's right. That's a backdoor Roth. So the answer would be no, unless I'm missing something.
Okay. So Sarah has asked, is the 3% surtax on trust income based on net income less expenses?
Net income less expenses. I'd have to check on that. Again, how they're defining the income on that. Let me check on that.
Okay. And then Terry has asked, what is the likelihood that the 400,000, 450,000 income thresholds become indexed in future years?
I know, right? I know. I've seen nothing about that, and I would not count on that right now.
Right.
We do have a couple of people who are asking to have access to these slides. If they could get a copy.
See my earlier comments about becoming a member of Savvy Tax Planning. So that would be the answer for that.
Yeah. And then let's see. So Ed, I had a question. As professionals, do we try to anticipate and guide clients to preempt changes in the tax code or wait for the bill to be signed into law? Too many times in my career have we seen language in bills ultimately change or laws change under future administrations?
Yeah, I mean, this is very fair. It's very fair. That's how Sean started. I do not disagree. These are judgment calls. So, for example, for some of my clients who are really exposed from an estate planning standpoint, we set up these trusts and we set up these family limited partnerships because the risk was way too high. And you see a constant theme of them wanting to lower the estate tax, the lifetime exclusion. So there are times where, you move forward. And then there are other times you take a wait and see approach. So you're right. I think a lot of it depends on you and it depends on the client. I think the thing we need to be doing across the board is we need to be having these conversations with clients. We need to be educating them. That is a sine qua non. You've got to do that because if and when some of this stuff goes through, if you weren't having these conversations with them, I think you could be left very exposed and with some very frustrated clients. But as far as taking action, that is collaborative, right? That's teamwork between you and the client. And that's just a case-by-case thing. But yes, absolutely, you're right.
So Kate said, Sean, you might mention that you can also be a member of Savvy Tax Planning if you're a master member and have access.
Thank you, Kate. I assume that's Kate the Marvelous out there.
It is.
Yes, of course. If you're a member of Horse's Mouth's Master Member Program, which you have access to everything at dramatically reduced price and special discounts off of our live workshops. And by the way, if this thing does pass, I'm sure we have our Savvy Tax Planning School for Advisors. We'll crank up a new version of that for sure with Jeff and Debbie. So, yeah, and the other point I wanted to make is that we have seen over the last 5 or 6 years that advisors more than ever really do need to know their way around these tax issues. And irrespective of what happens relating to the items that Debbie has been covering, the fact that you can communicate with your clients about this, have conversations, it builds your credibility, it builds your stature. Yes, this is my guy, or this is my lady who's, my CFO, who's watching out for me, taking care of all these things, regardless of what does happen in Washington. And so I think I'll end by simply saying, this is not a situation back in like 2008 where the Dems had, a significant margin. This is really, really close. I don't know what's going to happen. It really is. I've been watching this stuff for 40 years, and this is a very, very, tightly controlled Congress. And the idea of moving through major things is really highly challenging. So we're just going to have to watch and see, what Pelosi and Schumer and others are able to pull off. They're reaching big. They've reached big. Yes. And I think they've reached big also because ultimately they know they'll have to pull in their horns. Some of this may happen, some of this may not. Maybe none of it happens. Maybe all of it happens. Who knows? Stay tuned, though. Join Savvy Tax Planning because Debbie and I are on having this conversation every month. Otherwise, have a great rest of the day and a great weekend.
Thank you. Stay safe.